So far, we learned about regressions, the Markowitz efficient frontier of investment portfolios, William Sharpe's capital asset pricing model. We learned how to calculate a portfolio's risk, return, variance, and covariance. We know what beta is and how it can be interpreted in Sharpe's capital market line context. That's excellent. We are making excellent progress. And in this lesson, we'll add another tool to our arsenal of financial knowledge. We'll learn how to interpret the intercept of the CAPM model, alpha. In the world of finance and investments, alpha is often thought of as a measure of how good or poor the performance of a fund manager has been. The standard CAPM setting assumes efficient financial market and an alpha of 0. Given that beta multiplied by the equity risk premium gives us the compensation for risk that's been taken with the investment, alpha shows us how much return we get without bearing extra risk. A great portfolio manager, someone who outperforms the market, can achieve a high alpha. And conversely, a poor investment professional may even obtain a negative alpha, meaning he underperformed the market. How does a manager try to outperform the market? Well, to do that, he can't simply invest in a diversified portfolio, sit back and relax, right? He has to select the winning portfolio of stocks. That's easier said than done. But investment professionals have profound knowledge of certain industries, companies, and the stock market, and will try to outperform the market. This can be done by hand-picking successful investments, a la Warren Buffett, or through active trading strategies. The term active trading means an investor will try to take advantage of short-term price changes. You don't simply buy a stock portfolio that replicates the S&P 500. You have to pick a portfolio of stocks that is winning. And because other investments will eventually catch up and the price of these shares will normalize, you will have to sell these shares and select a new group of winning companies. This is active trading. The typical time horizon of active investments depends on the situation, but could be from one day up to several months. Active trading is the basis on which investment professionals justify their fees, and this is an important point. If an investment professional charges you 1% of the invested amount, he needs to outperform the market by over 1%. Otherwise, you'd be better off investing in a passive fund that charges you a tiny portion of the invested income. We should always pay attention and shouldn't forget alpha is comparable only when the risk profile of the investments being compared is similar. We shouldn't compare a portfolio of small, illiquid companies operating in an emerging market with a well-diversified portfolio of blue-chip companies based in the U.S. The proof that most investment managers struggle to produce an alpha consistently different than 0 caused an important trend in the investment industry. Most investors know that well-diversified and passive index tracking funds charging low fees are very efficient and started to consider them as a solid alternative to active management strategies. William Sharpe believes investors should bet on the efficiency of markets and shouldn't bother paying high management fees, given only 2% of funds have a positive alpha that is consistently different than 0. In our next lesson, we'll learn how to calculate the alpha of different investment vehicles, and we'll try to analyze their performance. This will do for now. Thanks for watching.